is going to be tested. Question? No. Good. We have lots to cover. So I have to warn you, the fun part of the class, to the extent you thought that was fun, hope you did, this is a little bit, as I mentioned, blocking and tackling, nuts and bolts, cut and dry. I'm actually going to cover a whole lot of different law today. It's kind of drinking from a fire hose, but I'm going to put this lecture online, and everything I'm saying is in your casebook, is kind of summarized in a chart, and I want to be clear that you're not expected to know this at a high level. I'm going to convey a lot of information today. We're going to work through it on Wednesday and apply it. I do apologize. There's really no other way to do it other than to telescope the course, but we're going to cover partnership law, limited partnership, general partnership law, limited partnership law, limited liability company law, including the revised Limited Liability Company Act, general corporation law, and some other general principles. So buckle your seatbelts. It's going to be really fun. Mr. Toad's Wild Ride. Yeah, super pumped about this. But it's going to get us where we need to go. We're going to get through a lot of content today. And if you guys can follow along, or if you can't, you have the video and your book. And, of course, the statutes are online. We're going to apply it and practice it next time. So what are we going to learn today? Well, I'm going to make it seem simple. 3 core concepts. All right? 3 core concepts about business entities. The first being the basic choices we have for business associations. We're going to have that question because you're going to be asked, 1/3 of your exam will be, what organizational choice should a set of founders employ based on their business needs? You need to know what those choices are. You will need to know the essential aspect of those choices. I'm going to try to cover that. There's a chart at the end of this chapter which summarizes it pretty nicely, but you can't just read the chart because it's sort of shorthand, so hopefully through today's lesson and the reading, you'll be able to understand and use that chart, and you can bring it with you on the exam. So if you understand it, because you don't have to memorize it, so you can bring that chart into the exam. And so the goal for today is to get you to understand that chart and its essential aspects on those different characteristics of formation, liability, management and control, financial rights, continuity of existence and ability to withdraw, transferability of interests, and mergers. And no, you don't have to write that down because those are simply the categories in the chart on page 174. So we're going to learn what all those things mean. And then we will talk about some of the planning considerations. We're going to get into that in our workshop next week as we talk about a hypothetical, My Green Home, and how do we help these entrepreneurs form a new business, and a little bit about the tax consequences. It's not a tax class, but you really can't do business planning without understanding corporate taxation. Corporations are taxed separately from individuals, and so that's fundamental. So know that I understand this is an introductory course. I'm speaking to you at a high level to convey a lot of information. I realize that you're not going to walk away from today being able to actually do business planning, but hopefully you will be able to come in class and practice some simple examples of business planning next week and have some ideas of what this would look like in practice. That's my goal there. Tax attributes as well. All right, let's talk about business planning. When you sit down with founders of a company, they have very different approaches to corporations than lawyers do. They're really focused on making the business work. They're really generally, unless it's a nonprofit, focused on how to make profits. They are not usually thinking about things like legal liabilities, about liability for debts. Basically, entrepreneurs are eternally optimistic, and lawyers, well, we're not known for being particularly optimistic. Lawyers are known for finding the problems, and oftentimes that's important, but as a business planner, there's sort of a special role where you have to understand where the business is coming from, and you have to help them meet their goals. You have to get to yes. You can't just say, this won't work, these are all the risks, these are all the problems. There's a lot of problems in the world, and we're not going to move forward if we simply dwell on them. We have to find some kind of balance between people who want to take risks and want to do something new with all of the challenges. And so we're going to try to get into the mindset of our business colleagues as we go through this. And to do that, we have to get some vocabulary covered, but we also should think about things that entrepreneurs care about. So what do you think some of those things are? 2 folks want to start a business. They want to start a business that sells solar panels, makes and sells solar panels. What do they care about? Money. Money would be one thing, but what about the money? What about the money do they care about? There's two of them. How about how they divide the profits? Right? I mean, the way that they share the money is going to be really fundamental to that relationship working. Right? They may have different expectations.
Probably how viable that business is in that area.
So how viable it is, right? And what happens if it fails? So maybe we should think about, so that's kind of a business side, like is this viable? And then what do we think of that? Well, if the business fails, you can't pay your bills, what happens to you, individual founders? What happens to the liability for failure to pay debts? Yeah, Tyler.
Try to figure out who's in charge of what.
Authority, management, right? Who's running the show here? Do I have to listen to you? Everyone wants to be, every entrepreneur seems to want to be in charge. It can be hard if there's 2 or 3 people. Yeah, Mary Beth.
Where are they going to get capital to start the business?
Fundraising, super important, right? Different ways to get money. I mean, they may have private wealth. They may have access to capital through other means, but most entrepreneurs are going into this and looking to have it funded outside of their own wallets. I mean, some bootstrap and they start with their credit cards, but are they going to go to banks? Are they going to go to private people? Is one going to be the money and one's going to do the labor? Other things they might be concerned about.
Will the startup cost of it?
Yeah, who pays the cost, right? Who's responsible for those initial costs? How much is everything going to cost? I mean, that's one thing I always hear from a founder. They want to hire me. How much does it cost? Like the lawyer is a cost. You have to realize in this world you're a cost. So that's definitely a different perspective. Other things they might think about. Yeah.
Regulations in the sector.
Yeah, we don't talk about that in this class, but regulations are something I study, work. I'm huge. Right before you go into business, I had a startup come to me and they wanted to. This was 10 years ago, kind of before apps, and they wanted to help remind the elderly to take their medication through text messages. It hit on HIPAA in a big way, and it basically stopped their business model. They just really couldn't send that information without violating HIPAA. And for that particular population, who could maybe do text but couldn't do apps based on their market study, the regulations eliminated the business possibility. We're not going to cover, that's more specific, we're not going to cover regulations in this class, but fundamentally important to creating or not creating a business. Anything else we can think of while we're kind of spitballing? What about leaving the business? I mean, what if you're done with it? What if you don't get along? What's your withdrawal rights? Can you cash out? Can you sell your shares? Can you give them to your daughter? I mean, what are your rights? What are your rights with regards to that? And what is the tax liability? At the end of the day, it's not just about how much you earn, but how much you get to keep. And there are some structures where you might earn nothing and still have a tax bill. It's called phantom tax, and that's a major issue for people to worry about. So we're going to frame that through legal concepts. So those are things that business people think of. As we bridge it, we're going to think about that through a series of 7 business legal concepts, right? And we're going to start with concepts about formation. Formation is about when the business begins and has to also do with how it ends. What are the formalities? What are the costs? What are the state? What's the choice of entity? Liabilities. Liabilities for debts and liabilities for contracts. Liabilities for torts that the corporation might commit. We don't do a lot of agency law here. There's a concept called respondeat superior. It means let the superior answer. And so a superior can be liable for the torts of a subordinate. So that liability shield and having different liability structures really matters because, those liabilities can be unlimited. Control, management. Right? Who is going to run the company? Who is second in command? And how is that going to work if there's 2 people? What are their voting rights? Do we want to appoint a third party whose job is to manage it? And of those people, is everyone involved have the authority to enter into contracts on behalf of the business, or is that something reserved for only a few of the members or officers or directors? Financial rights are always fundamental. How much do I get? What's my share? How much am I responsible for the losses or the startup costs? How much of the profits can I expect to receive? How much of this company is mine? And how do I deal with the tax? Right? What are my rights to get paid, for example, in that phantom tax situation? Continuity, that means how do I get out? How do I end this company? What happens when I'm done running this business? Or what if we don't get along? What if I leave because I don't agree with the direction the company is going in? Am I entitled to some withdrawal? Can I cash out? Can I force you to pay me? Does the company disappear? Or does it simply go on and I have no rights? That will depend on what entity structure you choose, and that matters a lot to entrepreneurs, depending on what they're trying to accomplish. Liquidity means transferability. How can I transfer my interest? I might be a 50-50 partner. I may not want to stop that business from functioning. Maybe that's a valuable business, but maybe I'm 83 years old and I'm ready to retire from the practice of law. Can I sell my half of the partnership? Do I need your permission? Can I sell my share in a corporation? Liquidity has a big impact because it actually affects how valuable that business is to you. Something you can't sell is generally less valuable than something you can. You can always use something that you can't sell, but you can't sell it. And so something you can use and sell, well, that's more valuable because if you no longer have a use for it, you can sell it. If you have trouble selling it, that's going to reduce its value. Yeah.
The continuity and liquidity, could they be the same thing?
They're very similar in the sense that, but liquidity refers more to permission before transferring interests, whereas continuity means, do I have the right to cause this business to stop existing, basically by my withdrawal? And we'll see that as we get into the partnership concepts a little bit. And finally, mergers. What if we have a great offer to be acquired, and how easy it is for us to roll this company up into a larger company or to acquire another company? And what you'll see, actually, if you look at this list, is this is actually how our book is organized, helpfully. So these 7 issues are the remainder of our casebook. And if we had next semester, all of your classes, we could potentially cover all of these topics. I would be delighted, but this is a lot. So we're going to do formation in this class, and then we're going to do liability and control rights next semester. Right? So we're not going to cover all of these topics. We're actually going to be offering advanced mergers and acquisitions simulation coming up, so look forward to that. In terms of financing, I offer the venture capital financing simulation, so you will have a chance to get this content in our upper division courses. But that basically maps on. Today, though, we're really just going to focus on how do you make a decision between essentially 3 main choices with a couple subcategories. And the first of those is going to be a partnership. What is a partnership? Can anyone define partnership for me? Uniform Partnership Act defines it. It's defined as an association of 2 or more persons, to carry on as co-owners a business for profit. An association, 2 or more persons, to carry on as co-owners a business for profit. We're going to see how that plays out. There are several types of partnerships, and there are reasons to evaluate between them. There's the general partnership, which has unlimited liability for everyone. There's a limited partnership, which has limited liability for limited partners, general liability for general partners. There's a limited liability partnership. I have one slide on it because it pertains to law firms. Law firms choose that because it has limited liability for corporate debts, but unlimited liability for malpractice. And that's necessary because most bar associations don't permit lawyers to hide behind a liability shield, and so you need to choose an entity type like a professional corporation or an LLP where there is liability for malpractice. So you can't avoid that liability. There's also some issues about fee sharing with non-lawyers, which is why most law firms are not corporations. There's also something called a limited liability limited partnership. Just don't worry about it. It's not useful anymore. It's been basically supplanted by LLCs. The 2 that you'll have to worry about are GPs and LPs, general partnerships and limited partnerships. Of course, this course is mainly about corporations. And if you want to think of these things as a spectrum, corporations are one end of it and partnerships on the other. We're going to see some of those really specific differences. Unlike a partnership, which has no real substance without its partners, a corporation is wholly separate from its shareholders. It's a completely separate entity, and as a result, a lot of different management structures, a lot of different liability provisions, different control rights, different liquidity rights, different withdrawal rights. Corporations, like partnerships, also come in several different flavors. Most of what we're going to be talking about is called a C corporation. This is sort of your standard corporation. A C corporation has something called double taxation. It's taxed at the corporate level. Corporate profits are taxed. And then when those dividends are paid to shareholders, that's also taxed. It's called double taxation. You can avoid that by making an election called an S election, and you would then have an S corporation. However, there are some limitations on when you're permitted to make that election. There's also an election to be a closely held corporation. That mostly has to do with management obligations, fiduciary duties, and things like that. So we're going to see that a little bit more next semester. It's a little bit out of the ambit of what we need to worry about for now. And there are also some nonprofit corporations. We're not going to talk about those at all. They don't have shareholders. That's basically all you need to know. They're not part of this course. We have an entire other course on nonprofit corporations. A lot of different rules, a lot of different fiduciary rules. We're going to learn about the fiduciary rules to shareholders who are owners. Nonprofits don't have owners. Completely different set of fiduciary rules, because who would you owe those duties to? But that is a type of corporation, a not-for-profit corporation, 501c3 they're often formed as. And we're also going to talk briefly about social benefit corporations, or B corporations, which are really a kind of like USDA organic. It's still Celerate, but it has a stamp on it. We're going to talk briefly about those. But the key ones you have to know about, going back to what's really important, are just distinguishing what is the difference between a C corporation and an S corporation. When I say corporation, I mean C corporation. That's the default, that's the normal, that's the average, that's the majority of this course, right? A separate entity. If I want to talk about S corporations, I will say about that specifically. And the difference is just tax. It's a different tax structure. It's a partnership tax structure. So as we talk about our planning, we'll talk a little bit about tax, and we'll talk about the S election briefly, 10, 15 minutes. But it doesn't change our governance provisions. And then our third and newest type of entity is a limited liability company, or LLC, and it's a hybrid of these two forms. In fact, it can look and feel very much like a partnership or very much like a corporation. So it's a very flexible entity choice. It's useful for a number of different things, but before you gravitate, there's sort of a the goal for this is you get the points in the exam. Some students tend to want to suggest a limited liability company for everything because it's flexible. Well, flexibility comes at a cost, literally. In order to form an LLC, you have to think through a lot of things which are standard provisions in any other entity. So it's not the default choice in all cases. It's not the default choice in all cases. You only really select the LLC if you need the flexibility, or if you're trying to achieve a corporate tax structure without the corporate tax. You want the corporate governance structure, but you want to pay a partnership tax, and for whatever reason you can't form an S corporation. There are because LLCs are so flexible, they can be cumbersome to form, cumbersome to govern. And outside investors are particularly wary because you don't know what you're getting when you buy a unit of an LLC unless you really carefully read the operating agreement, whereas a corporation is pretty standard. You don't have to learn about each corporate form. If they're standard and they're ordinary and there's nothing weird about it, you kind of know what you're getting in terms of rights. But since LLCs are so flexible and customizable, it can be hard for outsiders to know what they're getting. So it's not a great choice for people who are looking to obtain a large amount of outside funding for that reason. LLCs also have a couple choices, a couple flavors to them. LLCs can be formed either as a member-managed LLC, and a member-managed LLC looks like a partnership, or a manager-managed LLC, which looks more like a corporation, where you have a board of managers. And so we're actually going to learn about the partnership and the corporation, and in that way you'll understand the LLC because it can have elements of either. It just costs a little bit more to put it together because it's a little less standard. And it's been around for a much briefer period of time, so there's more uncertainty about liability for an LLC. There's just not that many cases. The first LLC statute was 1996. Corporations have been around for hundreds of years, so there's just a lot more case law in corporations. So it's a little hard to say what you're getting when you get an LLC in terms of what courts will do. Yes?
What about a professional corporation?
A professional corporation is similar to a limited liability partnership. It would be useful for an accountant or a law firm, but they would be they would have a board of directors like a corporation does, but they would allow liability for malpractice. So if you want to frame in terms of the LLC, it's kind of, the LLP is more like the partnership, is more like the member-managed LLC, whereas a professional corporation is a corporation, but it has additional liabilities which may be necessary in order to achieve that. So, for example, I think I've mentioned I have a very small and not particularly successful consulting company. Hopefully one day when I have more time, can actually earn money and not just take losses. I formed it as a professional company. Why? Well, I was able to make an S election. I'm a sole shareholder. There's some simplicity toward it. It was simpler to do than forming it as a partnership. The documentation was much more standard, easier for me to make, easier for other people to understand. It's just me, right? And it's actually also a closely held business, so there's fewer obligations for meetings and things like that. And I still have liability for malpractice through that corporation. That's the professional part of the corporation. But I enjoy a liability shield for debt. So if something, that sort of issue. But some law firms form as professional corporations. Most form as LLPs. Part of that is just stickiness. PCs are a little newer. They're not available in every state. Mine happens to be formed in District of Columbia, and I looked at the statutes because I'm a nerd. And, I actually read the statutes. I preferred the default rules that came with it. Most people would just choose something off the rack. So let's talk about partnerships. There are several types of partnerships, as I just mentioned. General partnerships, where all the partners have unlimited liability. Right? So that sounds dangerous. In fact, it is. The reason that we talk about general partnerships is not because you'll form them. You often will not tell your clients to form a general partnership. I'm very wary of the liability issues that come along with having a general partnership. If you're going out in the world, there's a real risk of committing torts or incurring debts, and very problematic if the founder has full liability for that, or even someone who's a 10% partner to have full liability. I mean, if you contributed 5% of the capital into a general partnership, you're fully liable for all of its torts and debts. That can be scary, risky, and problematic. So some people prefer the limited partnership form. Limited partners have limited liability. They can't lose more than they've invested in the business. There still has to be a general partner, so that's important to recognize. There's a general partner who has unlimited liability and a limited partner. So you can think of it as a GP-LP kind of structure. And we'll come back to this in a minute, but actually there's a way to get around the liability for the GP too. You form a corporation, the corporation is the GP. We also, as I mentioned, have LLPs and LLLPs, but I'm not going to worry about them right now. So let's define it again. What is a general partnership? This definition is important because you'll find that you can actually form them by accident, and that's where it really comes up on the bar. It really comes up on the bar because people have gone into business for profit, and they didn't file anything. A general partnership does not require a filing. A general partnership is a voluntary association of two or more persons to carry on as co-owners a business for profit. It doesn't say two people who intended to form a partnership. It doesn't say they filed a document with the Secretary of State of the state of Pennsylvania. It simply says that when two people associate to carry on as co-owners a business for profit, they have created a general partnership. They may have done so unwittingly. And we need to look out for that, because if our clients come into us and they are already carrying on a business, they both have unlimited liability for each other within the scope of that business. It's also the most basic type of a partnership. You don't need anything to do it. You simply go into business with someone, and that is a partnership. It's a default regime. But it might be one you want to avoid because of unlimited liability. A limited partnership, as I mentioned, is comprised of one or more persons who control the business, and that'll be the general partner, and one or more persons who simply contribute capital and share in the profits, but have nothing to do with the management structure. Nothing whatsoever to do with the management. In fact, as we'll get to in a second, how that works out depends on the law. I'll get to that when I get to that. All right. Here's a map of the states that have adopted a uniform law called the Uniform Partnership Act. And as you can see, there's actually a lot of homogeneity on this act. So model acts, you probably are familiar with them from the Uniform Commercial Code. Model acts are statutes created by the uniform laws or some other body, and they go around the states trying to encourage the states to adopt this as state law. As we know, corporation law is state law, partnership law is also state law, right? It's a state entity. It's all about state laws. It's not a federal law class at all. So what laws have the states adopted? Well, fortunately for us in our study of this, almost all of the states have adopted a fairly modern version of the Uniform Partnership Act, including Pennsylvania. We'll actually find Pennsylvania is a weird outlier in basically everything else, but at least they're middle of the road on this one. And the name of that statute is the Revised Uniform Partnership Act of 1997. You can abbreviate that RUPA, R-U-P-A, RUPA. And that's pretty consistent, and you'll see there's going to be a lot of parentheticals here, but when you see RUPA, that's the Revised Uniform Partnership Act that applies to Pennsylvania, that applies to the vast majority of the states. The rest of them have adopted the Uniform Partnership Act of 1914, if you're just interested in trivia. Right? So in North Carolina, their partnership law dates back to 1914, essentially, as a uniform law. All right, so let's talk about RUPA, and let's see what it has to say. RUPA says a partnership, shock, shock, is an association of two or more people to carry on as co-owners of business for profit, formed under Section 202 precedent law or comparative law of another jurisdiction. So, what section should we look at to see how a partnership is created? Let's take a look at 202. 202 again says it is created by the association of two or more persons to carry on as business as co-owners of business for profit. That forms a partnership without any filing. And in fact, RUPA goes so far as to clearly state that they formed that partnership whether or not they intended it. Intent is completely irrelevant to the formation of a partnership. If two people are associating, two or more people are associating to carry on as co-owners a business for profit, they have formed a partnership under state law in the vast majority of states. And by the way, Uniform Partnership Act said something very similar. So that means a partnership can be formed by accident, and that means that partners can be liable for each other without even realizing it. Yes?
So is there a regularity requirement for this? Because oftentimes people will engage in things where they make money together for brief periods of time. Like when we were younger, my brother and his buddy, they would mow lawns together in the neighborhood.
Mm-hmm.
Could that constitute a partnership?
Absolutely. You and your buddy get a lawnmower, borrow a lawnmower, and you walk around knocking on doors and charging $5 to mow the lawn, you have formed a partnership. And if your buddy runs over somebody's garden hose and causes a flood, you are liable for that damage, even if you weren't there at the time.
Even if you're 16 years old.
So that's, I haven't seen that case. Certainly if you're 18 years old. We've been sentencing children to prison for far worse, so I wouldn't be shocked. There's nothing in the statute which has an age requirement, but I think courts would be reasonable. I haven't seen the case. So for now, we'll talk about adults, or at least 18-year-olds, if they will constitute adults. But that's exactly right. Two 18-year-olds go around the neighborhood offering to mow lawns. They have formed a business. They have formed a partnership. And if one of them damages somebody's car while hauling that lawnmower around, the other is fully liable for that damage. And you can see how this would be a real risk. I mean, your buddy might not have $5,000 to fix somebody's, Porsche 911 that you just put a saw blade through the window or whatever, right? And they can come after you for that. Absolutely. That's what unlimited liability means. Yeah, Joanne.
Is there an end point to this, like by corporation law?
Yes, we will talk about how a partnership ends. A partnership can be dissolved, there can be withdrawal, and partnerships tend not to last forever, right? So that is one important component, and that's where we get to the continuity concept. How do we end a partnership? And any partner, and the short answer is if either of the two partners says, I'm not interested in this partnership anymore, under the old law, that would cancel the partnership. Under the new law, that person is no longer part of that partnership and has a right to be paid out. Yeah. There probably are a lot of dangling partnerships just hanging around, but there are some ways to officially kind of cancel it. All right, so I have the question again here. I should stop asking this. Can a partnership be formed unintentionally? Yes, it's fundamental to know. It's on the bar like every third year. Always comes up. Someone, two people are doing business, and people are missing that because they're like, well, they didn't file anything. You don't have to file anything. You're liable. Two buddies with a lawnmower. One runs over the garden hose. The other might have to pay for it. So let's talk about some of those features, and let's walk through those different aspects of how a general partnership would work. So by the way, I'm always referring in this section to RUPA. The Uniform Partnership Act of 1914 is a little different, but since it's a tiny minority of the states, I'm going to focus on Pennsylvania law wherever I can here. We'll get back to Delaware law next week, 2 weeks from now. So what's the general default rule? Well, first off, by the way, everything I say here is subject to an important caveat that you can create an agreement to do almost anything. But we're talking about a partnership that is formed without an agreement. Two guys on a lawnmower is the best example haven't come up with, better than any example I've come up with, right? Because you can really get the intuitive sense about that. They probably didn't sit down and hammer out a partnership agreement. So they're probably bound by default rules as found in the statute. So under the default rules, again with the caveat that they could agree differently, how is it governed? Equally. equally. Each partner has an equal right. Doesn't matter if one provided the lawnmower and the other one just provided, I don't know, what's a much less expensive part of lawn? The rake. One brought the rake and one brought the lawnmower, right? Lawnmower costs how many more times than a rake? 50 times more than a rake? For good, I don't know, 20 times more? Substantially more. So you have one person who's a 95% contributor, one's a 5% contributor, but if one brought a rake and one bought a lawnmower, they both have equal governance rights. It's not based on how much they contributed. Everyone at the partnership table has that equal vote. If you've ever been at a law firm, you'll see this is true also. You have equity partners who are making $17 million a year, others who just got promoted to partnership, but at that partnership meeting, it's one person, one vote. That's the default. And ordinarily, decisions are made by majority vote. So it's just a matter of majority, which means, by the way, what happens if you have two people and they don't agree? Nothing happens. It's a problem called deadlock. And so deadlock can actually lead to dissolution. If we had more time to talk about partnerships, we could look at some of those cases. And I'll just mention, though, a good partnership agreement, to the extent that you write partnership agreements, you might for a limited partnership, although rarely nowadays you see people forming general partnerships with formal documentation, there should be a provision to deal with deadlock. You may not want that partnership to dissolve automatically. But bottom line, GP control, one person, one vote, majority rules, and if you reach a deadlock, it can end up in dissolution. Finances default a little differently. This is more probably what you would expect. So partnership accounts are a little complicated, and you probably don't want me to stand up here and talk about accounting for 45 minutes. Thanks. Because I don't know if I have that much content on general partnership accounting. It's complicated, as is the tax structure. It's a flow-through tax structure, and you'd have to take a really advanced, you would learn basic income tax, corporate tax, and usually partnership and LLC tax, more advanced than that because it's more complicated. But in terms of how much you get profit-wise, each partner contributes something of value. So we have the rake and the lawnmower example, and then they're described as having their own account. And so the way this works is that this account or this balance, you add the contributions and you add their share of profits. And those share of profits, unlike the vote, are based on your pro rata contribution. So if the rake is 5% and the lawnmower is 95% of the total contribution, the person who, without other agreement, the person who contributed the lawnmower would have more rights to the distribution. Although, of course, you can agree otherwise. It doesn't have to be formal. I mean, when you go into business with your buddy and you go out in your lawn care business, you probably have a conversation about how are we sharing the profits. And so, again, that's an agreement. You don't have to even have that written down. This is not as important as the liabilities. Usually it's the liabilities that really matter to people because they suddenly get hit with a bill they didn't expect. And as I mentioned, if you bring a rake to this enterprise, you are now a partner. And if that other partner causes damage, you can imagine you could do a lot of damage in a business, right? You're driving around with heavy equipment. Yeah, you got it, whatever. And so there's a lot of liabilities that can be had. So the liabilities are unlimited for each, regardless of how much you contributed. And so that's an issue. There is one exception. So it's sort of just a minor rule, but and I'm not going to test on this, but the bar likes to test on the quibbly little rules. The one that they usually get to is that if a person only contributes their skill, doesn't bring a rake at all, contributes none of it, then they're not liable for the debts. So just sort of a minor rule, and you can see that in example 6.7 on page 145. Just take a look at that, and when you get to the bar exam, something to think about. In that example, A and B form a general partnership. A contributes all the capital, all the equipment, and B only is doing the work, only mowing the lawns. When the business produces losses, A cannot force B to contribute to those losses because he is not a capital contributor, and so it's sort of an all or nothing. It's been a very contentious rule, but it is still the rule, and it's something that comes up from time to time outside of this class. So the rule here is that partners generally share jointly in profits and losses unless otherwise agreed. Doesn't matter your contributions, joint sharing. If one partner contributes only capital and the other contributes only labor, then that person is off the hook. They're not going to be responsible. Yes?
So you said joint sharing in profits and losses, but then what about that account you were talking about where you each have pro rata contributions?
I think I confused that. I apologize. Let me reset. The partnership account works that this is how much the partnership owes you, and so that's based on your contributions. And so if this will come up in a minute when I get to withdrawal. So when you bring a $5 rake to the business essentially owes you the value of that rake. That value is added to your book, and if you receive a distribution of the profits, that's subtracted from the amount that the business owes you. And so we kind of maintain that balance in that way. Like if a company makes business, it might leave it in the bank account. If a partnership makes money, it might leave it in the bank account, or you might say, I'd like my share. The share is usually 50-50 unless otherwise agreed. So how much of that you're entitled to. So there's a different concept between your account and your share that you're entitled to. So I see some confused faces. The fundamental thing here is in a partnership, things are 50-50. You have one vote. You have one. If there are two people in a partnership, they have 50-50 rights to vote, 50-50 rights to control, 50-50 rights to profits, 50-50 obligations toward losses, regardless of what they brought into the business. That's the more fundamental concept. I should have led with that. In addition, there's a concept of a partnership account. And so when you bring something to a business, that's added to what the business sort of owes you, and then as you take that share of profits, that's deducted from how much the business owes you. So we kind of maintain these partnership books. And again, as I mentioned, I kind of glossed over the accounting because we're not going to really deal with that. The fundamental thing, again, liability, unlimited liability for everyone who brings any capital to the business, and this notion that unless you agree otherwise, everything is 50-50, or 33-33-33, or 25-25-25-25. It's all equal unless otherwise specified. And unfortunately, so is liability. Which partners can be liable? All of them, any of them, regardless of how large their contribution was. So illustration 6.2, example 6.2 illustrates that. So if you look at page 141, it says that A provides capital, the money, right, the equipment, and controls the day-to-day operations in B's custom automaking business. A receives a share, A shares control, doesn't have total control, has some control, and a share of the profits, not all the profits, when the automobiles are sold. And so this is a partnership. A and B are engaged in a business together. They're associating for the purpose of making a profit by making cars. So if B agrees to build a car for X, but disappears and breaches that contract, A is completely liable. They are both completely liable, joint and several liability. There is one limiting factor, is that only pertains to things that are within the scope of the business. So A and B are partners. They're in the business of making cars. There's a lot of things that go into making cars. You might order supplies, right? You promise to pay $10,000 for a windshield. So that bill comes due. Someone has to pay it. Both people are liable for that bill. Someone might try to buy a car from you and you don't make good on the promise and they sue you for breach of contract. Contractual liability there as well. In the process, you might build the car wrong and someone gets injured as a result of that. It's tort liability. Both are liable for that. That's all in the scope of the business. But let's say your partner goes out and goes to Chuck E. Cheese with his kids and starts screaming profanities in the ball pit. Something wild like that. Right? Trying to lighten things up a little. Glad, thank you. You all paying attention? So you've got your partner screaming profanity in the ball pit at Chuck E. Cheese, and he's arrested for this. Are you liable? No. No, that's not within the scope of the business. The business is making cars. It has nothing to do with Chuck E. Cheese, at least I assume so. And as a result, that's not going to be something the other partner is liable for. So it's only things that pertain to the business where we create these liabilities. Okay. Continuity. So how long do these things last and how are they ended? Right? It's a really important question. You've got this liability. How do you get out of it? So this actually, I'll briefly talk about the Uniform Partnership Act of 1914, just because it actually highlights something a little more fundamental about a shift in the law. So again, Uniform Partnership of 1914 is not the law, not the jurisdiction of this classroom. It's not the jurisdiction of the exam. I just want to bring up this example, not to confuse you, but in order to show you the difference in how the law has changed. So you don't even need to take notes on this, just think about it. Don't confuse yourself with this one. Under the old rule, the one you don't have to write down, if one partner dies or removes himself from the partnership, says, I don't want to participate anymore, the partnership then was legally dissolved. It would no longer be able to exist. If any partner left, that partnership would no longer exist. Anyone could effectively create a dissolution of the partnership at any time. This turned out not to be a horrible thing, because let's say there are 7 partners and one leaves. If the others continue carrying on a business, they have sort of formed a new partnership with the 6 members. So sometimes it took care of itself. But this shows an idea of the partnership being completely related to the partners. Under the Uniform Partnership Act, there is no concept of a separate entity. A partnership was entirely of the partners. And so if one partner left, the partnership was a combination of partners. So if one partner left, the partnership would cease to exist. Now, for the rule that matters. For the RUPA 1997 approach, it offers a new possibility, that a partner can disassociate without dissolving the company. This concept of disassociation is saying, I don't want to be involved anymore. It doesn't, by itself, destroy the company. And so what this signifies from a theoretical basis is that under states that have adopted the revised Uniform Partnership Act, which are most states, including Pennsylvania, there's the idea that the partnership has some sort of separate status on its own. It's not quite as separate as a corporation, but it's certainly entangled with the individual people, but there's a little bit of tension there, and the law seems to be moving in the direction of recognizing partnerships as an entity on themselves, that they have some sort of existence beyond merely being an amalgamation of partners. As a result, one partner can disassociate without forcing the partnership to dissolve. And the remaining partners can simply pay that partner his share, and the partnership will continue existing. So this is called a buyout right, and they don't have to dissolve to do it. So a person disassociates, they have a right effectively to force a cash out. So, you don't want to mow lawns with me anymore? Fine. You can walk away, and you're entitled to your share. The problem is that usually that's under very contentious circumstances, and it can be hard to get that money, as you can imagine. For any of you who have had a business partnership or a personal, any kind of personal relationship going south where someone walks away, hard to get your stuff back, hard to get paid, hard to get that to work. So you'd have to go to court, but under Pennsylvania law, you can go to court, say, I disassociated from the partnership, I'm entitled to an accounting. So you can actually force a judicial accounting where the court will order that the partnership kind of produce its books and records. An accountant will determine what it's worth. Your share will be evaluated. Your account will be evaluated, how much the corporation owes you and how much you owe the partners. I keep saying the partnership, the business. I'm going to say business. How much the business owes you, and in that way you can force a cash out without causing the partnership to disappear. Yes, many hands. Yes, start here. Start here.
If the partnership doesn't have any liquid assets, are you forced to sell something to pay your share, or can they give you your things back?
That's a good question. Can you actually force because that would be almost like a default. I don't think that under the Revised Union Partnership Act that disassociating can force the remaining partnership to liquidate assets. I think those would be owed and would have to be paid like in terms of like an income stream or something like that. I don't actually know that though, but I think that's right. I think that's right. As opposed to but if it was a full-blown dissolution, absolutely. That would cause a winding up and a liquidation. But since the partnership continues operating as a going concern, no, I don't think it forces a liquidation. That money is owed, but it doesn't necessarily have to, because that would cause the business to stop functioning. And I don't think that's the result that the law seeks. Yeah.
What if there's only 2 partners, and if that wouldn't meet the definition of general partnership under RUBA, if you just have one person? So would you have to then?
Okay. So. Yeah, it would no longer be a partnership. It would continue existing as a sole proprietorship, sort of default to a sole proprietorship. Okay. Other question over here? Yes.
Can you form a general partnership with an LLC on it?
Yes. The partners don't have to be natural people. The partners can be other partnerships. They can be LLCs. They can be corporations. So there are many types of, I shouldn't say any entity, but certainly those types of entities can be partners in a general partnership. You can be partners, and in fact, the way that most limited partnerships are organized, as we'll talk about in a minute, the general partner is almost always a corporation to avoid liability to any one person. Yes, you don't have to be a natural person to be a member of a partnership. Yes?
How does, if two LLCs join in a general partnership, how does that affect liability?
So the liability would stop at the LLC level.
Okay.
So that actually would be a sort of an unusual structure, but the LLC would block the liability at that point. So if a dissolution occurs, though, so if a partner, so as I mentioned, under RUPA, a partner who wants out, you don't have to dissolve. The partner who wants out can disassociate, and the partnership has to pay him his fair share, which will be determined by a judicial accounting. And I think, as Joanne pointed out, I don't believe that requires a liquidation of the business assets, because that's what happens under a dissolution, which specifically does not happen here. A dissolution, though, or a dissolution winding up, is when the business stops functioning and it pays off its creditors in their order of priority. So it's going to pay its debts first, and then it divvies up the remaining cash within the partnership or assets. And so those assets and cash will be distributed accordingly. So that's the concept of a dissolution. All right, transferability. Can a partner simply sell his interests? Can someone else kind of stamp in your shoes? If Mary Beth and I are partners in this lawn care business, can I sell my stake in that to David? Is there free transferability of partnership interests?
I would think there wouldn't be, because it's two people making this kind of informal arrangement.
Yeah, the people matter in a partnership, right? And partnerships are not separate entities the same way corporations are. The people matter. They're sort of extensions of the people. No, the default rule is that all current partners, all of them, unanimously must consent to a transfer of a general partnership interest. Oh, and by the way, just a couple terminologies. So when we talk about corporations, we talk about stockholders, and they have shares or stock, or shares of stock. When we talk about partnerships, they have interests. That's their percentage interest. It's a percentage. We talk about LLCs, we talk about units. All those concepts are related and similar, but we do use different terms when we're talking about different entities. So corporations, shares, stockholders; partnerships, partners with interests; and LLCs, members with units. So just using the right terms in the right places. So exactly, you can't simply trade places with somebody. RUPA section 401 says that. Says it very clearly. A person may become a partner only with the consent of all the partners. Pretty straightforward. Unanimous consent. Now, of course, you could have a partnership agreement that says otherwise, but it usually regards unanimous consent. And likewise, the only transferable interest, but you can do something with that. So you do have, as a partner, some rights. You cannot transfer your control, because, as we were discussing, that's sort of fundamental. Like, you want to go into business with a certain person, and that person has a vote equal to yours. You can't just transfer that to David, right? If you don't know David, you might not want to work with him, so you have that right to refuse that. But as a partner, I have the ability to assign my profit interest. So I can have that profit interest assigned. And Section 502 says the only transferable interest of a partner in the partnership is the partner's share of the profits and losses of the partnership. So I can't transfer my entire interest, I can't transfer my control rights, but I can assign to Mallory my profits. Or for that matter, I could assign the losses. You'd have to accept that assignment, but I could assign that. That's just a financial matter. And so the revised uniform partnership does permit that. So it's not total transferability, but you can transfer profits and losses, just not control. Can partnerships merge? Yeah, that's really easy. They simply combine their assets. They just have to have an agreement where they combine their assets. So partnership mergers don't require any filing with the state. They simply combine their assets by any private agreement. And partners in the non-surviving partnership become partners with the surviving partners. They all, or you could think of it as they all become partners in a new partnership. Either way, you smush the assets together by some type of agreement, you have you can either think of it as a new partnership. Really, the Uniform Partnership Act, the old one, would have thought of that as a new partnership. The revised Uniform Partnership Act, the concept would be that the old partners join the existing partnership, but the effect is the same. A merger is the simplest possible under a general partnership. You don't need to file anything, just agree and combine the assets. So those are kind of our 7 elements there. Let's talk through some of how LPs are different. That was the basics of partnership law. Now, LPs, limited partnerships, are partnerships, and much of general partnership law applies. The only way that LPs are really different pertains to the limited partner. So you can start with what you just learned about partnership law, and as a result, I'm not going to go through all the 7 elements and reiterate everything. So we have a lot to go through, and it's boring enough already. Sorry, but we're going to get there. At least I can acknowledge it, right? I actually don't know if that helps. Yeah, it's always something interesting. So under an LP, really what I wanted to share with you is how LPs are different. The problem with talking about LPs is that Pennsylvania here is a bit of an oddball and is somewhat of an outlier. Most states have not adopted the... also, by the way, there's been like a ridiculous number of versions of this statute. I'm just going to briefly run through them with you. There are like charts that have all this in there, but the first Limited Partnership Act came out in 1916. But it's been revised several times. The revised Uniform Limited Partnership Act, which is now called the Uniform Partnership Act of 1976, was promulgated in 1976. But then in 1985, they revised that. Then they put the name back to the Uniform Limited Partnership Act, which is the same name as 1916, which is confusing. But some people call that one Revised Uniform Limited Partnership Act. And then in 2001, there was a revision, which is colloquially and oddly called RE-ROLPA, or Revised Uniform Limited Partnership Act. That just rolls off the tongue. So the simplest way to do it is you add the year. So, Uniform Limited Partnership Act 2001. This point's been revised so many times that calling it like the Revised Uniform Limited Partnership Act gets a little silly. So we'll just call it the Uniform Limited Partnership Act, 2001 to signify it's the newer version. The older version is 1985. Most states still have the 1985 rule. Your book talks about the 1985 rule. So I'm going to go over today just a couple of the key differences between the 1985 rule and the 2001 rule so that you know Pennsylvania law for the Pennsylvania bar exam. And there's just a couple things that I have found have been tested on, so I'm going to just bring those up today. All right, background though. Why form a limited partnership? What's a feature of it? You have, in a limited partnership, you have a general partner, and the general partner controls the business. The limited partners have limited liability, but they have to be passive. In fact, under the 2001 version of the law, it actually states in the statute that they have to be totally passive. They cannot have any active role in the management. So this is what you usually find in some kind of financing fund. The GP is going to be the fund manager. They're going to decide how to allocate the investment. And the limited partner, they're just the money. What you might even call dumb money. There's a concept in venture capital of dumb money and smart money. Smart money is more actively involved in management. Smart money would be like a VC who sits on the board of the company and provides additional resources outside of money, like general advice and oversight, and maybe being the adult in the room when you have a bunch of 19-year-old founders that would prefer to have keggers and things like that at the office. And someone has to be like, it's not a great idea, But you'll see this with funds, and so you just associate LPs with fund formation, and you'll be fine. You can use it for other things, but they're mostly used for fund formation, and the LPs then are going to be some kind of passive investor, and the GP is going to be the active investor. And as I mentioned, in order to avoid the liability for the LP, the GP and the LP, the general partner in a limited partnership will often actually be a corporation, and then there'll be a person who runs that corporation, and that blocks the liability in that way. So LPs are then going to be a partnership that has general partners and limited partners. The general partners have general liability for all the debts and torts. The limited partners are only liable up to the extent that they have invested for losses.
Is the GP then like a real corporation, like the one that you actually work for, or is it like a dummy corporation you set up in order to be the fall guy for the liability?
They tend to get really complicated. I mean, oftentimes there's like very, very like elaborate structures of like layers and layers of LPs within a fund. The corporation exists for the purpose of limiting liability, and I don't know if you'd call it a dummy corporation. I mean, It is not the alter ego of a person. They're not like using that corporation as their private piggy bank or anything like that. We'll see that issue. But yeah, the reason that corporation exists is to stop liability at that point. And the stupidness of that is why we have LLCs, effectively. I mean, people realize that this is just dumb. Like, we're trying to make somebody liable, but everyone found an end run around that in the 70s. And so since then, it took a long time. It took from basically the late 60s and early 70s where people realized that there's this easy way out of liability. Just you basically pay a tax by having an additional entity that you pay $200 a year to have registered, and you're fine. You don't have any more personal liability. And so states began adopting limited liability company statutes to provide investment vehicles without the need for this dummy corporation. They're not called dummy, they're called blocking corporations because they block liability, but they don't do anything other than that generally. And they're generally, they're just one person. So what we'll find then, as I mentioned, is that LLCs can do much of what LPs do. There's a lot of overlap. Right? As I mentioned, an LLC can look like a partnership, and it certainly can function like a manager. We'll get to that when we get to that. But there's less and less role for LPs, so why do we have them? Well, we have them because they're historic. People are used to them. You're used to, like, LP sort of means investment fund. When you see that someone is the general partner of a limited partnership, you're not surprised when they're talking to you about investing money. I mean, it's sort of a brand. There's standard forms for that. It has been perpetuated over a long time. So anyway, just associate LPs with funds, and you'll know what to do for my exam. But also know that LLCs can also fill that role just as well. They just might not be as well understood by your kind of old school investor types. Like CalPERS and all the old school major institutions, they move slowly and they still like their old forms and they're used to it and they spend a lot of time and effort getting them just right, and they're not necessarily coming around. But there's a lot of limited liability company investment funds now. Question?
Well, it's a comment. You know what they used to use this for? To my recollection, I don't know if they still do. Theater shows. The producer would be the general partner, and then the angels would invest in the show. They want to produce a Broadway show.
Yeah, well, they certainly could do it that way. That the producers would have to be a general partner in a limited partnership. But I would imagine more and more they're forming limited liability companies. And more than that, we're going to get to LLCs. I'm kind of jumping ahead, but they'd probably form a series LLC, and that would allow them to have different shows under one entity with liability separating them. But I'll come back to that. So how do you form an LP? Unlike a GP, you have to file. Everything other than the GP and a sole proprietorship, you have to file. You file a document. You file what's called a certificate of limited partnership. The Pennsylvania statute reference is section 8621. It says quite simply, to form a limited partnership, a person must deliver a certificate of limited partnership to the department for filing. What does that have to include? It has to include the name of the partnership. And there are some rules about how you can name a partnership. If you're feeling like checking out subchapter A of chapter 2, you can read them. But you can't call it a bank. You can't call it a university. There's some rules that pertain to that. There's some things you can't say about it, So you do have to file it, and there's we'll go over this in 3 weeks from now when we do a formation. We'll look at how you can look up names and see if it's available. Can't be already taken. It has to have the name of the company, and it has to have a registered office where you could serve process and sue the limited partnership. And this is important. You also need the name and address of each general partner. So there is that element, and that's a public document. So if you form an LP, and this is another reason to form an LLC instead of an LP, form an LLC, you don't have to provide anyone's name and address. If you form an LP, you have to provide the name and address of the general partner. Now that might be a corporation, but now you have to have a separate registered agent for the corporation, and that has to be it creates a lot of expense. Creates a lot of additional expense. So LLCs are more popular, they're cheaper, they're easier. But people understand LPs, they've been around for a long time. And under the Uniform Limited Partnership Act of 2001, it really makes the point. It's very, very strong in saying that the purpose of this is strong centralized management and weak limited partnership who are only there for the money. They have no role in the management. Section 406A in the Uniform Act says, expressly as provided in this act, any matter related to the activities of the limited partnership may be exclusively decided by the general partner. Exclusive. The others have no rights whatsoever for any decisions relating to the partnership, or if there's more than one partner, a majority of the general partners.
So does piercing the veil apply here? If they would, could they be liable?
Yes. So we'll talk about piercing the corporate veil. There's obviously concepts like piercing the limited liability company veil, so limited liability has a limit. It's not, you can't just run a corporation for your own personal benefit without observing any formalities and get away with it. There are some obligations to meet before, so you're not going to be found liable. Sorry, I've just got a low battery warning, so I'm going to turn my screen down, make sure I can get through the class. But that's the things that apply to piercing the corporate veil and corporations would also apply to limited partnerships. But just like I mentioned, people are more hesitant to invest in limited liability companies because there's less case law. There's a lot less case law about piercing, so it's hard to dispositively say, piercing a limited partnership in Pennsylvania happens with these kind of things, because those cases come up so infrequently. But it would certainly require the limited partner to be actively involved in management and essentially using that partnership as an alter ego of themselves, which would be violating the act anyway, which says they're not allowed to be involved in any management decisions. So we'll learn next semester about the piercing the corporate veil doctrine. We're going to talk about that with regard to corporations. Yes, you can pierce other entities. You can think of it as limited liability is not unlimited. So this was a change. That was an update that we really had to eliminate. So that's something to know from Pennsylvania, is that Pennsylvania does not permit any participation. And the other thing Pennsylvania does, which is sort of the flip side of that coin, has to do with liability. So as I mentioned, the general partner is always liable for all of the debts and torts of the entity. But most modern partnerships have a blocking corporation that is going to eliminate liability to persons. Under the old law, again, pencils down for a second. This is not the law of this jurisdiction, but under the 1985 law, limited partners could become liable by actively engaging in management. So they would essentially become de facto general partners. If someone was named a limited partner and had filed as a limited partner, but acted like a general partner, under the 1985 law, they could be treated like a general partner for liability purposes. That's not the case in Pennsylvania. Pennsylvania is an outlier in that respect. Under Pennsylvania law and the 2001 Uniform Limited Partnership Act, and for the sake of this class and your bar exam, interestingly, LPs never have liability, except with a very rare case where they're really doing some fraud or even if they somehow participate in management, at some limited level, that doesn't automatically kind of convert them into GPs. So the other distinction then, in addition to the forcefulness of that they can't participate, oddly it's also protection for them if they do. So there is something called the control rule in the casebook that pertains to the 1985 rule, but it doesn't pertain to our law in Pennsylvania, so don't worry about this control rule. You obviously won't be tested on it. You wouldn't be tested on the bar exam either. Even if a limited partner does engage in control, with the absence of something really egregious, they're not going to be liable. Financial accounting, I'm going to make this simple. It's governed by agreement. You're going to have an agreement. You're going to have a filing. Usually these are funds formed by sophisticated people and sophisticated investors. So they have a very complicated financial structure, and usually that's almost always by agreement. So don't even worry about the default rules. It's flexible. You can do it however you want. You can say, well, you only gave 5%, but you get 50% of the profits or whatever. And usually the general partner, for what this is worth, gets something called the cash and carry, a percentage of money under management and a percentage of profits. But it's all just a subject of contract. So all you need to know about LP financial accounting, it's usually governed by contractual relationships that can be however you want it to be. Otherwise, the default rules that I mentioned about general partnerships apply here as a default rule, but you're never going to see that, because if you're going to bother forming an LP, you're going to have a partnership agreement before you accept it. And you'd be a fool to invest in an LP if you didn't have some concept of what type of rights you had to profits. And the whole point of being an investor is to get those profits. So they only invest if they have, and usually they're fairly robust agreements on that, 80, 90 pages long, a lot of detail. Way beyond the scope of here. Let's talk about LLPs for 1 minute, because there's a question. What's the difference? So LLPs are similar to general partnerships in the sense that the partners are liable for malpractice. But they are not. But it's similar to an LP in the sense that the partner is not liable for ongoing debt. So the example that I give, you're in a law firm and you have a contract with you're a partner at a law firm and you have a contract with Xerox to provide new copy machines. And for whatever reason, the law firm goes belly up and you owe Xerox the company partnership owes Xerox $10,000 for an expensive copy machine. That's the sort of liability you're protected from, just like you'd be protected in a corporation. However, if you've committed legal malpractice, that's the type of liability you won't be protected from. So LLPs are required for many lawyers. And their use is actually falling off because there are professional corporations, and people have started to use LLCs as well. There's some historic reasons, though. I mean, certainly in law, people like the idea of kind of one person, one vote. There's some simplicity to the structure. But basically all you need to know about LLPs is that they're only going to be used by professionals who need to use them. You would never choose if you didn't have to. Right? Why would you pick an entity type that gave you more liability? Only if you had to. And you do have to if you're a lawyer. You can't avoid that. You can't hide behind a liability shield of a company or a corporation. So you need to form a professional corporation or an LLP. So when would you advise this type of organization? When you see an accountant, when you see an attorney, maybe a doctor. The example I would give would be attorney, right? As I put up on the screen here. So attorneys need to use this form, or a professional corporation. They might choose the professional corporation if they wanted more centralized management. They might choose the LLP if they wanted more flat management, but they don't have access to some of the other forms. All right, let's talk about LLCs, because that's going to kind of put a couple things together. And an LLC is kind of new. And as a result, we're still kind of learning about them. We're still trying to actually figure out how to take advantage of all that they have to offer. They happen to be very flexible, although some of that flexibility has been a problem. And as a result, the newer statutes have actually created some default rules that limit flexibility, or at least provide some default provisions that make it a little easier to form. So it was available since the late 90s. The Uniform Act was 96. I think it was 95, then it revised in 96, and that's when it began being adopted by states. It was adopted by all the states, but I have the map here. But in 2006, and then again, these are all like a lot of amendments and a lot of back and forth for those who follow these sort of things. In 2006, they came out with what they called the ULCA, another really pleasant acronym, Uniform Limited Liability Company Act, sort of the second version, the second generation of the statute, and that has not been adopted by very many states either. However, we are in one of the weird jurisdictions that did, so it bears a little bit of mention as to what is the difference between our Limited Liability Company Act here in Pennsylvania and the General Act, as you will hear about if you hear about LLCs. I'll start with sort of the basics, and then I'll talk about how Pennsylvania is different. So, the key thing to know about LLC is that they're highly customized. I was looking up customized. I found this like really tricked out motorcycle. This is sort of my symbol for customized. I mean, you wouldn't see this in a showroom. Like there are like 3 people in the world that want a bike exactly like that. But it's cool that you can do that, and LLCs are sort of that way. And as you can imagine, this motorcycle is quite a bit more expensive than one you'd walk into a showroom and buy. Right? I mean, it had to be specially designed. It's probably, there's all kinds of tricked out and custom-made billet aluminum and what have you. Just like that, an LLC needs to be customized by an attorney. I could do an incorporation for $1,000 without sweating it. I mean, it's pretty easy, and we'll see. We're going to go through the forms and the paperwork. You'll leave this class with a pretty good idea of how you would do it. I don't feel comfortable writing operating agreements, especially because there's very complicated tax issues that come along with them, and we have to deal with. So that really drives a lot of the challenges. I mean, you have several different levers. You have, this concept of units, and the units have to do with ownership, but ownership is separated from profits, and you have to deal with then profits and losses, and that's separate from control and voting, and who gets to run it and who gets to this, and that's separate from taxes and who bears the tax. So you have these 4 different financial issues just there. You have to address all 4 of them, and they kind of pull you in all different directions. So you have to understand tax law really well, as well as the dynamics of the business. And like I said, like a lot of students want to gravitate for saying, like, use an LLC because it's flexible, but it really is expensive. and if you sat down and read an operating agreement, you wouldn't understand it. I mean, no offense, I don't understand the tax section either. There's always like a tax partner in the office who specializes in that. And you can get used to it, but it's really quite complicated because you're dealing with so many different areas of law, and especially because partnership tax law changes annually. So in addition to being a corporate attorney, now you have to also be on top of all the changes in LLC law, which has not a lot of case law, so it's hard to research and know what your client's liability will be. And on top of that, you're dealing with changes in partnership taxation, which also changes annually. So I really try to reserve these type of entities for people that need them. There has to be a specific purpose that you're going to actually get advantage of that flexibility. Or if you're not looking for outside investment, there are ways to do them simply. They're certainly simple if you only have one person. If you only have one person, who controls it? That person, right? Who gets the profits? That person. Who can be called on to pay losses? That person. So a one-member LLC can be done on a single page. But a multi-member LLC, once you get above one members, you're looking at documents that are 50, 60 pages in length and have complicated mechanisms for profits and losses and taxes and all that kind of stuff. I can post one on the Blackboard, actually, if you're interested in seeing it, so you can take a look and get a sense about that. But a lot of clients come in, they want an LLC, they heard they're flexible, they heard they have tax benefits, but I actually find that the S corporation often is simpler, and unless you have reasons to look, you can blow an S election. We'll talk about that as well at the end of next class. You can only have 100 members, and they have to be U.S. taxpayers, and there's about 5 requirements for an S corporation. But if you meet the requirements, why not? It's simple. Keep it simple, stupid. I mean, that's a good mantra for corporate attorneys. It's very easy for attorneys to overcomplicate things. That said, there are roles for it, and we'll talk about that tomorrow. We'll talk about roles for an LLC, and it's good to mention. It's always good to mention that an LLC is an option. So, again, questions 1 through 5, if you do see a structure, which, a lot of times you should mention, an LLC is one possibility. An LLC is something to mention, but you also might talk about whether it's necessary. It's more expensive. Should you tell your client to spend more money than they need to? Is that ethical? Is it ethical to drive up bills? Of course not. No, you should try to get the right result for your client, especially a small business. But you should think about them, and you should think about how they can be many different things, but you don't always need that flexibility, and you don't always want to pay for it. All right, so what do? You file a document. It's called a certificate of organization or an articles of organization, depending on what jurisdiction you're in. It has to include 2 things, the name and the registered agent. And the registered agent does not have to be you. You can pay someone to do that. It's cheap, too. It's like $40 a year. So if you want to create a company and you don't want anyone to know who's in charge, this is your form. You can have the most anonymity possible with an LLC because you don't have to disclose any of the members' names on a public filing. So that's one reason to do it if you're trying to keep things anonymous. How is it managed? Well, it depends. It's going to be the answer to almost everything. But there are 2 major structures. It can be manager-managed, in which case it's kind of like a corporation where there's a board of directors or a board of managers, or a manager. It could be one manager, it could be several, in which case it's a board of managers. You can structure it different ways. You can structure that each manager gets 1 vote and it's a majority. It could be that they have to reach unanimity. It could, however you want to do it. But that looks kind of more like a corporation. Or it can be member managed, which looks more like a partnership where the members each have the authority. You could also, as I mentioned, lots of different levers. The amount of votes that a person had could be based on their capital contribution. The amount of vote a person had could be based on 1 person, 1 vote. You could come up with some other kind of metric, and it's all for the attorney to draft and figure out. So some of you may be excited because it's a big, wide open sandbox, but again, all these things mean these are all things that have to be discussed with the client, all different precisions to work out. LLCs are designed to be flexible, and so you have a lot of choices. How are financial rights distributed? Who gets the profits? It depends. It depends on what you put in the operating agreement. Again, it's very customizable. There's a great deal of variation. Some are that you get equal profits. Every member gets, there's 3 members, they all get 1/3 of the profits. You can do it that way. Could be that the members get a share of the profits based on their capital contribution. I supplied the rake, that's 5%. You supplied the lawnmower, that's 95%. I get 5%, you get 95% of the profits. We have to write it down. We have to figure it out. We have to have that conversation and structure that. How long does it last? similar to the other entities perpetually, unless it's more like a corporation in that regard. It exists in perpetuity. It is a separate entity, like a corporation is. That there's none of this mishmash of kind of semi-separate and semi-similar to the partners. It's a separate entity, like a corporation is. And so it exists in perpetuity unless it's built with an expiration date. You can put in the founding documents, this limited liability company will expire, dissolve, and wind up on November 1st, 2020. You can say that. You can do whatever you want, like I mentioned. But in general, unless you do, they exist forever. There's not this concept. What happens if a member wants to withdraw? It depends. It depends on how you structure it. You could follow a partnership model where a withdrawing member might have the right to demand value. You could structure it like a corporation where they have the right to transfer their interests freely. You could structure it however you wanted to. So you have to think carefully about how you want to structure the withdrawal rights. But it doesn't trigger a dissolution unless you put that in the operating agreement.
You put an expiration date on it and it doesn't exist anymore, and down the line someone wanted to sue, would they still be able to sue the LLC or the individual?
Nope. No, once you dissolve it, there's nothing. It's vapor. It's vaporized. And now, if you did that wrongfully, there might be some piercing, and you can go to the person that did that wrongfully. But if it's dissolved and wound up, and all the proceeds are distributed, someone comes around to sue it 5 years later. There's nothing to sue. Nothing to sue unless there was some wrongdoing there, or someone was acting fraudulently, or otherwise you would have had a veil piercing case. You won't succeed in that lawsuit. Yes.
Are there businesses that kind of on a revolving basis purposely, keep like starting a new LLC for that very reason?
Yeah, like fronts for the mob, right? That corner store that changes its name every 7 months or whatever. Sure. There's, I don't know if it's legitimate, but
I
yeah.
just wondered if could that ever happen?
So the backstop to all of this is that courts will not permit you to use the corporate form or the limited liability company form or the partnership form for fraud and wrongdoing. It exists as a creature of the state. We've talked about that pretty extensively. And so courts will pierce and hold liability when you're acting fraudulently. But if you're acting in the normal course of business and there's good reason, yeah, that's totally doable. It's expensive to do, so you wouldn't, it costs money to form, it costs money to dissolve, you have to pay off certain taxes. And keeping it operating makes more sense, but you have these businesses where they shut down and restart, and aside from fraud and wrongdoing, that would block liability of the new entity even. Yeah. By the way, so those of you who have thought about this, right, this is all about externalization of risk. That means that when someone goes to sue, there's nothing to sue. And that's a harm that's borne on society as opposed to internalized by the company. This gets right to the heart of the tension we have in corporations. And this is a special privilege that corporations and companies have, that, as a result, some people feel that we're able to ask more of them for it. Are LLC members personally liable for its debts? This one's pretty easy. They're not liable, just like limited partners are not liable, just like shareholders are not liable. Now, it doesn't mean they can't become liable. If you have a limited liability company and you just formed it, and you go to the bank and you say, I'd like $1 million, the bank will say no. The bank might say, I need a personal guarantee. And so people can make themselves personally liable, and you do see that pretty often. Most people who have a small business have to essentially co-sign for that business and impose that liability on themselves, but it doesn't happen by default. The exception is when the LLC, and this is also a doctrine called defective incorporation, there can be a defective company formation. If the company is not formed properly, there can be some liability there, and there can be liability in the veil piercing. But those are sort of the corner cases. We will talk briefly about defective incorporation before we finish the course, because that's another one of those, I think, not very important subjects that the bar tests on a lot. So, I try to cover all the bar stuff as well as the fun stuff. Today is more of the bar stuff day, as you can tell. All right. What's the difference between, speaking of what's on the bar, what's the difference between our law and most of the state's law? I'm just going to go briefly through some of the differences to highlight what the revised act has. This is the 2006 act. First, under older statutes, you had to elect when you filed to be member managed or manager managed. Under the new statute, that's in the operating agreement, so you can change it much more easily, and you don't have to publicly disclose if you're member managed or manager managed. So it's moving even further toward the sort of privacy thing and flexibility in that regard. So, the operating agreement will set up the management structure, and you can change that at will by an agreement of the units, of the unit holders, the members, provided under the so the operating agreement then is going to govern the structure, not the filing. So that's the first difference. The other difference, and this is actually a big deal. Under the old law, an LLC could only engage in for-profit business, but under the new law in Pennsylvania, an LLC can engage in nonprofit business. So now there's this new form which could be used for nonprofits, and that's just sort of interesting. So as I said, we don't study nonprofits here, but now there's a concept of nonprofit limited liability companies. That's a new concept under the 2006 law. It wasn't available under the 96 law. So you can run an LLC for a nonprofit business. Other changes. Under the new law, there are more default rules for corporate governance. So I'm not going to go through them all, but as I mentioned, the structure and operating was very hard because you had to really figure out all the management, all the voting, all the control issues. The newer statutes tend to have more default provisions, and that provides two benefits. One is you can keep the operating agreement shorter if you're okay with the default provisions, and it provides a starting point for negotiations among partners. It gives them something, they have a sense of sort of what's normal, what's ordinary, and because it's in the statute, and you sort of have to push. It takes effort to move from a default provision. It anchors. So the newer ones have more default provisions about internal affairs. The newer statute has a slightly more flexible management structure. Basically, it specifically permits a board of managers. It was possible with a bunch of work and a lot of fancy lawyering to have a board of managers under an old LLC statute, but the newer LLC statutes make it very easy to have a board of managers. So there's sort of almost a third choice. You can have member managed, like a partnership, manager managed, like one person, a CEO, and now this kind of board of managers concept, which looks a lot like a corporation. So if you don't want the corporate form, you can elect this, and you can get a lot of the corporate structure without the corporate form. The other thing that was updated was duties of care and duties of loyalty are now definitely applied to managers. So it's clear now. It was not clear before if managers of a limited liability company under the old rule had liability under duty of care, duty of loyalty. It was sort of, you had to look at general agency law principles. We're going to learn about that next semester. Now you can know that those things apply to Pennsylvania LLCs as well. However, there is, under that statute, you can actually in the operating agreement limit that liability. You can say the managers are not liable for those things. But the default is that they're liable just like corporate directors are liable. So if you have that manager-managed structure, again, it's making it more corporation-like as a default. And finally, under the old act, it was not entirely clear who could bind the company, whether managers or members had authority in various cases. The newer statute is clearer, and it stipulates that managers and members can bind the company based on common law agency in the state of Pennsylvania. So agency law applies. There's no other statutory layer, so you can use common law of agency to determine whether a manager or member has authority to bind a company. And we'll be talking about that in about 5 weeks. So you can look forward to that. Section 8. Basically, Section 8 of the Third Restatement of Agency is going to apply to Pennsylvania limited liability company managers.
Are you saying bind the company, like B-I-N-D?
B-I-N-D, bind, yes. Like if a company wants to enter into a contract, who can sign? Who has the authority to act for the company? Authorization. Yeah, who has authority, right? Who has authority to bind the company means who can act for the company in a way that the company would in fact be liable for that action. We're going to talk about that extensively in I'm calling it week 5 and 6. I've lost track of the new semester, right? That's week 5 and 6, and that's section 3 on here, and that applies to LLCs just like it applies to corporations in Pennsylvania. All right. Oh, and I should mention the Uniform Association that came up with this said this is all great. It's going to reduce costs and streamline administration and create consistency across jurisdictions. Of course, no one adopted it. Very few people adopted it. You seem shocked. That's the chart. Blue is who adopted it. Not that many. So for whatever reason, people don't seem to agree with the Uniform Commission just yet, and it's not entirely clear if this is going to improve things, but it is the law that we have to live with here in our great Commonwealth. All right, let's talk about corporations, and then we'll hopefully be able to wrap on time. If there's a spectrum, Corporations are at one end and partnerships are on the other. A partnership is a flat structure, one person, one vote, equal rights. A corporation is really the opposite. You only get what you put in. Shareholders have no management rights at all except for voting for directors. We're going to be talking, of course, about corporations extensively throughout the rest of this course, so I'm just introducing them here to give you a perspective. So here's sort of my little handy chart of the differences, just to show you how different they are. On the left, my right, we have a partnership, and on the right we have a corporation. And we're talking about rights of partners versus rights of shareholders. Partners, as a default, have a right to participate in daily management, everyday decisions, major decisions. Shareholders have no rights to do that. Only to vote for directors. They don't have any say in what the corporation does on a day-to-day basis. In general partnership, every partner has unlimited liability for all the corporation's debts and torts. In a corporation, all the shareholders have only limited liability. They can only lose what they invested, no more than that. In return for that liability, partners of a general partnership have agency authority. If you are a partner, that is showing to the world that you have authority to bind a partnership. If you're a shareholder, that shows the world you have no rights to bind a partnership. Shareholders cannot, I'm a shareholder of Microsoft. I can't make them enter into a contract. Right? So that becomes obvious when you think about it. Whereas if you're a partner in a law firm, you can make a contract with Xerox for that copier. I wish we had a contract for a new copier. Wouldn't know. Whatever. I'm glad it can duplex. That's all I can say. And tax liability. So tax liability is going to drive a lot of these decisions. Partners have a tax liability directly. The entity is sort of a little more intertwined with them. The tax liability flows directly to the person. Whereas in a corporation, you're a shareholder, you only get a tax hit if you sell your shares and have a capital gains, or if there's a dividend distribution and you get cash in your hand. And so they're really different in that way. Oh, and by the way, what corporation am I highlighting here? What corporation's headquarters is this? I thought I heard it. Apple, yeah. This is Apple's new $6 billion headquarters. Yeah, the mothership, the spaceship. Those are solar panels around the whole thing, by the way, which is pretty cool. All right. How do you form a corporation? You file a document. That's true of everything except what? What are the we learned about one, really. There's another one. It's not even really a major entity. Two types of entities you don't have to file. Sole proprietorship, general partnership. Don't have to file. Everything else you have to file. Corporations you have to file. You file with the Secretary of State. You have to include the corporate name. And interestingly, the number of authorized shares. We're going to come back to that. We're going to look at that in critical detail as we deal with formation. And the name and address of the incorporator. So we'll look at that as well. The articles can also state things like corporate purpose and other regulations, and you can limit the power of the company, but you rarely do. This is all going to be covered in 2 weeks. How is a corporation governed? Centralized management, not a flat structure. Partnerships are flat. Everyone, one person, one vote. That's the default. Not the case in corporations. Corporations are one share, one vote. You have to pay for those shares. And all you can do with those shares is appoint directors, and the directors run the company, not the shareholders. The legal authority to manage a corporation's business is vested in a board of directors, which is elected by the shareholders. So very major decisions go through the board. The board, however, usually appoints like an officer, a CEO, a CFO, a COO, other executive officers who they serve at the pleasure of the board. They can be hired and fired by the board. Again, not by the shareholders. The board has to do that. But those officers do have authority to make corporate decisions. And we'll see a couple cases where the president of a company outstepped his authority. And we'll see how that played out. In MTI Dage. All right, so how are the board members elected? Usually by a plurality of vote. We talked already about cumulative voting versus straight voting. There are different voting techniques, so you can remember that. How about financial rights? This also is easy, thankfully. It's really easy. It's pro rata. You get a share of the profits based on your number of shares in the company. 100 shares, you have one. They make a distribution, you get 1% of that. There's 1 million shares, you have 10,000, you get 1%. Right? It depends on your percentage, your pro rata share of the shares. And you're only paid if the directors declare a dividend. Are you liable? No liability for shareholders, with the exception of piercing the corporate veil. And as we see, that will only happen for very small corporations where you have 1, 2, maybe 3 shareholders. By the time you get to a corporation with 5 shareholders, you almost never see veil piercing. But Generally, the rule is that shareholders have limited liability, with the exception of that doctrine that we will learn. But that is the exception. Again, it's a very highly tested doctrine, even though it rarely happens in practice. But for the rest of this course, I'm going to make sure we cover everything you need to know for the Pennsylvania bar. So we will be talking for 2 weeks next semester about piercing the corporate veil. But don't get your mind too wrapped up about it. It doesn't happen very often. It's really a rare thing, just something to test on in corporations. And something we'll talk about next semester. Can you transfer your shares? Well, if you look at your book says corporate shares are freely transferable. While that's true on a technical level, that's not really true on a practical level. I mean, for one thing, if you're the stockholder in a small company, no one might want to buy your shares. I mean, in order to transfer your shares, someone has to want to buy them. In order to sell them, you need anytime you want to sell something, you need someone to buy it. So the general rule is that shareholders are free to transfer their stock without the consent of the corporation. That's the default. But they have a broad right to sell to other investors, but that doesn't mean anybody wants those shares. Whether you can sell your shares and how much you get for them is going to be contingent on the market. And so that's a limitation. Market conditions limit transferability of shares. Also, securities law restricts transfer of shares. Shares in a corporation are a security, and securities laws apply to sale, original sale, and resale. So we're not going to learn about the security laws in this class. I hope we can talk about them in other classes. They are complex and interesting, obviously beyond the scope here, but they provide transfer restrictions as well. And so federal law can thereby restrict transfer. And in addition, corporations can limit. The default is that there's free transferability, but a corporation can put in their bylaws that the board of directors has to consent to transfer, can put that in the certificate of incorporation. Shareholders can even agree among themselves privately. If Mary Beth and I are shareholders in a company, I can write a contract with Mary Beth that we mutually agree not to transfer our shares without the other's consent. We can write that document. We can have that contract. So while corporate shares are the most transferable about any of the entities we talked about, the idea that they're freely transferable is a little much, because there are all these ways that there are these transfer restrictions that pop up in other areas of law. How long does a corporation last? Forever. I mean, unless it fails. But usually they don't have an expiration date, and since they are separate from the people that founded them, person dies, those shares get inherited. Corporation rolls on. You know, they're selling your shares does not cause a dissolution or anything like that. So a corporation, we say, has perpetual existence. Doesn't mean it will last forever. Corporations fail every day, but technically they have lives that are independent of their owners. They can be dissolved. You have to file a document, but unlike a partnership, you know, if you dissolve the company, you can't force a dissolution. A shareholder can't. A small shareholder cannot force a company to dissolve, just like they can't force a company to do anything. Right? If you're a shareholder, all you can do is appoint the directors. You might be a 99% shareholder, but aside from voting for the directors, you cannot force that company to dissolve. If you're a 99% shareholder, you should be able to appoint directors who will abide by your wishes to dissolve the company. But technically, shareholders cannot force a corporation to dissolve. Nor do they need to. They have limited liability. They can sell those shares. They can exit in other ways. They can't force a cash out like a partnership. So in a way, you're a little more stuck. And they can merge. Mergers and acquisitions of corporations is a huge topic. It's complicated, and it's a subject of an entire module. You have to file a certificate of merger, so it is more complicated. And in addition, there's quite a lot of law pertaining to mergers and acquisitions. We're not going to deal with that here. But know that corporations can merge, but there are some definite complexities to it that you don't have in a partnership. You do have to make that a public filing. All right, with the 2 minutes left, I'll just kind of reiterate that there's a chart at the end of the chapter. And my goal for today was to help you to understand this chart. You can bring this chart with you onto the exam. I think it will help you in making an entity choice. As I mentioned, looking at the chart without the benefit of reading the chapter and having this lecture, I think is a little bit hard to read. But I hope you now can understand how we look at all these more than seven, this one columns. You know, how is it formed? What are the liability for partners, members, or shareholders? How do partners, members, and shareholders vote? How do they control the company, or how do they manage it? What are their financial rights to profits, and what is their expectation of coughing up money in order to cover losses? Can you force people to come up with losses? What's the tax status? We're going to talk about that more in our planning day next week. Does it continue forever, or does a withdrawal force its dissolution? And how do you change membership? And so we have those concepts here. Hopefully this helps you kind of look at that. Go back and review the chapter. By the way, the reading load for the rest of the semester is greatly reduced. I appreciate all the work you've put in to the midterm. As you probably noticed, for the next 6 weeks, I think there's like 140 pages or 160 pages of reading for the entire 6-week period. So I hope you do read it carefully. It can be a little dense. This was the densest of all of them. We'll try to go through it in class, but I really appreciate all the hard work and effort. And from here on, there's a lot less reading, but I know it's new concepts, so you might have to supplement that time by looking up a couple things. Come to my office hours, feel free. So that's it. We're going to come back next Wednesday. We're going to pick up with a discussion about My Green Home. So you can get a head start by looking at that hypothetical. We're going to talk about some scenarios, try to give some advice to some clients about what type of organization they would form, and that will lead us to our next section on how to form a corporation. We're going to just kind of assume, arguendo, that we've selected a corporation. And so you won't be tested on forming the other entities, but you will need to know which to pick. Thank you.